You ever pull up a stock chart and just feel completely lost? It's this wild dance of green and red lines, peaks and valleys, and it can feel like you're trying to read a language you've never seen before. But what if I told you there's a way to decode it? That's what we're doing today. We're diving into technical analysis, basically the art of reading the market's mind.
I mean, look at it. It's a jumble that just looks like chaos, right? So you have to wonder, is it all just random noise? Is it just a giant coin flip with our money? Or are there actually patterns hiding in there? Clues that could tell us what might happen next?
You know, this quest to find some kind of order in the financial chaos is nothing new. It's as old as the markets themselves. And over all that time, two major schools of thought, two competing teams, have emerged. Both are trying to solve the same puzzle, but they come at it from completely different angles.
So on one side, you've got fundamental analysis. You can think of these folks as the company detectives. They're the ones digging through financial statements, economic reports, all that stuff. They're trying to figure out what a company should be worth, its true intrinsic value. But on the other side, you have technical analysis, the market psychologists. They say, forget the balance sheets. They believe the only thing that matters is the chart itself, because the chart shows you exactly how people are behaving. They aren't asking what a stock should be worth, they're asking what the crowd thinks it will be worth.
This entire idea was captured perfectly by Charles Dow. Yeah, that Dow, the guy who created the Dow Jones Industrial Average. He basically said, the market price already accounts for everything. Every news headline, every earnings report, every hope, every fear, it's all baked into that one single number. So for a technician, the job isn't to second-guess all that information. The job is to analyze the final verdict, the price itself.
Okay, so if all the answers are supposedly right there in the price, how do they do it? How do technical analysts find a clear signal in what, to the rest of us, looks like a bunch of static?
Well, when you boil it all down, technical analysis is really the study of just two things, price and volume. That's it. Technicians believe these two data points tell you everything you need to know about the ongoing battle between the buyers, the bulls, and the sellers, the bears. It's like a direct window into the market's collective mind. And the technician's number one tool for looking through that window is the chart. It's what turns all those boring numbers into a visual story. Now, there are a bunch of different types of charts, but one of the most popular and powerful is the candlestick chart.
So let's build one of these things piece by piece. Each candle usually represents one period of time, like a single day. First, you have the thin lines at the top and bottom. People call them wicks or shadows. All they show is the absolute highest and lowest price for that day. Simple. Next, you have the thick part, the body. This tells you where the price opened and where it closed. And finally, the color tells you the story of the day. A light color means the price closed higher than where it started, a good day for the bulls. A dark color means it closed lower, a win for the bears.
But here's the really cool part. Every single candle is more than just data. It's a miniature story. A long, light-colored body, that shows you a day where the buyers were totally in control from start to finish. What about a candle with a really long wick sticking out the top? That tells you the buyers tried to push the price way up, but the sellers fought back hard and knocked it back down before the day ended. Each candle is a snapshot of pure market psychology.
Okay, so one candle is just a single snapshot. The real power, the real insight, comes when you start stringing them together over time, because that's when two really fundamental concepts start to emerge from the noise.
The first, and honestly the most important one, is the trend. This is just the general direction the price is moving. An uptrend is just a series of higher peaks and higher valleys. A downtrend, you guessed it, a series of lower peaks and lower valleys. For a technical analyst, identifying the trend is job number one. Everything else comes after that.
The second big concept is support and resistance. The easiest way to think about these are as psychological floors and ceilings for the price. Support is a floor. It's a price level where buyers just seem to consistently show up and say, nope, we're not letting it fall any further. Resistance is a ceiling, a price where sellers tend to take over and stop it from going any higher. And it's so important to remember, these aren't magic lines. They are simply visible areas where the market, as a group, has formed a consensus.
All right, now this is where things get really interesting. Because when you take the idea of a trend and you combine it with these floors and ceilings of support and resistance, something fascinating starts to happen. Recognizable patterns begin to appear.
So what are these chart patterns? Well, they're basically pictures of market psychology in action. And because human behavior, especially when it's driven by fear and greed, tends to repeat itself, these patterns also tend to repeat themselves. And technicians believe that gives them real predictive value.
You can pretty much sort these patterns into two main buckets. First, you have continuation patterns. These suggest that the current trend is just taking a little breather before it keeps on going. But then you have reversal patterns, and these are often the ones people get most excited about because they signal that the trend is running out of gas and might be about to flip around.
To make this real, let's break down one of the most classic reversal patterns out there. It's called the double top, and it's a huge warning sign that an uptrend could be coming to an end.
So here's the play-by-play. First, the price is in an uptrend. It rallies up to a peak, and then it hits that resistance, that ceiling, and pulls back. That's peak number 1. Then, the buyers try to rally again, but they fail at that same resistance level. And importantly, this second attempt often happens with less buying volume, less conviction. That's a major red flag. The final confirmation, the nail in the coffin, is when the price then falls and breaks below the support level, the floor, that was created in between those two peaks. What you're literally seeing is the balance of power shifting from the buyers to the sellers, right there on the chart.
So when a technician sees a completed double top pattern, the message is loud and clear. The bullish momentum, that buying pressure that was driving the price up, is exhausted. The sellers are now in control, and a reversal to a downtrend is very likely.
Phew, okay, so we've gone from what looked like chaotic scribbles to specific, named patterns with psychological stories behind them. So what is the big takeaway here?
At the end of the day, technical analysis is really the study of investor psychology, viewed through the simple lens of price and volume. It's founded on the idea that all known information is already reflected in the price. And, crucially, that because human nature doesn't really change, the chart patterns created by our collective actions tend to repeat themselves.
And that brings us to the biggest, most fascinating question of all. Do these patterns actually work because they have some mysterious power to predict the future, or is it something more like a self-fulfilling prophecy? I mean, think about it. If millions of traders all over the world are looking at the exact same chart, and they all see a double top pattern, and they all believe it means the price is going to fall, what do? They all sell. And because they all sell, the price falls. So is technical analysis reading the future, or is it just reading the crowd?